Hey everybody, MortgageSeth here, coming to you today from beautiful San Francisco. Wanted to share with you a tool that I've been using to talk to a lot of my clients about the benefits of refinancing. There's a lot of news about rates going up and down, mostly down lately, and it's really a good time to look at your overall debt management plan, including your mortgage, and see what other debts that are out there that could be included in your mortgage and what the overall impact of doing a refinance to either pay those things off or just do a straight refinance to save some money on the monthly payment. So here's a debt consolidation worksheet that I put together with the help of my friends at MBS Highway. And this is based on a current value of a home that was purchased a few years ago, say for $500,000, seen some appreciation. So the existing home estimated price is about $580,000. So on the left side here, we have the current mortgage balance, which is about $385,000. That's assuming you put 20% down when you purchased it. And the results on the right side are the proposed amount from the new debts that would be rolled in here. So we'll get into the details here in just a minute, but I wanted to show you the overall picture. With this example, I'm talking about consolidating about $60,000 worth of debts and reducing a monthly payment by about $1,490, so $1,500 or so. So let's get into the details. Up here, you can see property value stays the same, of course, and the loan balance is increasing by the amount of debts that are being paid off plus the closing costs. So it's reducing the amount of equity in the home, which is what you'd expect. And then we can look at the new loan details. And in this example I put together, I think it's a good one because it shows that even if you had a lower rate, you can still have a big benefit from refinancing, consolidating some debt, getting those under better control, getting rid of those high interest cards or other payments that you have, personal loans. So even in this example, if the rate is almost 1% higher, if we're going from a 3.5% to a 4.25%, there's still a significant savings to be had. So not even just in the cash flow of the payment, but overall in the equity that you have and the value that you can build over time. So let's look up here at the payment overview in the top right. So currently we've got the principal and interest for the mortgage. The existing is around $2,400, and the new proposed principal and interest is around $2,800, and that's rolling in the $60,000 worth of debt. Of course, the payment's going to go up, the loan amount's going to go up, but now we're going, instead of having $4,600 in total debt service payments each month with the mortgage and everything else, it's reducing that payment by about $1,500 by paying off these other items. So down here on the bottom, this blue section, I've made some assumptions and just put together a typical scenario that I see. You know, there's a vehicle loan, maybe $30,000, personal loan, $10,000, some credit cards, and of course, if you have something like an auto lease, we're not going to pay that off for you. That wouldn't be something that's smart to do. Wouldn't pay off a lease, but that's not included in this example. So the overall debts are $62,800, and what that does for the payment, the old payment was over $2,000 a month on these debts, and now by putting it into the mortgage, it's only increasing the mortgage payment by about $500 a month, so saving around $1,500. So here's the bottom line. If we go all the way down to this bottom section and look at the investment of that savings. So if you were to take the $1,500 or so that you're saving, that you're netting out in cash flow each month by paying off these other high interest debts, and if you put that back into the mortgage, then even though we're going to a new 30-year mortgage that maybe you've only had for a couple years, so you're worried about resetting the clock, that $1,500, if you put that back into the mortgage each month and pay down the principal, you're basically cutting your mortgage time in half. So people always ask me, does it make sense to put other consumer debt, other high interest debt into my mortgage? Shouldn't I just work on paying that down instead of getting a new mortgage and rolling the debt in there? And the answer to that is no, because if you put that extra money that you're saving each month into the mortgage principal, then you're going to pay off your mortgage a lot faster and reduce the amount of overall interest that you're paying to the bank over time. So in this example, if we put the whole $1,490 back into the mortgage principal each month, then that reduces the number of payments required to pay off the house by 200 payments, and you're paying it off basically almost 15 years early is what it comes down to. So that's increasing the net worth because you're gaining the equity in the house, you're getting rid of the other debts, and those are all the things that I wanted to point out to you. If you want a customized debt consolidation worksheet, you want me to run through your specific scenarios, see if it makes sense. Like I said, it may make sense even if you have a lower rate to refinance, to get rid of that debt. But also we know that rates are low right now, so if your rate's over 4%, and you're thinking about doing a refinance to save some money, we don't have to reset your term to 30 years. We can do 28 years, 27 years, whatever is most convenient for you that you're comfortable with. And we can go through all the scenarios and make sure that at least you have the information to make the best decision. So let me know how I can help. Again, MortgageSeth here. You can find me on the web at mortgageseth.com, or you can reach me in any of the links below. So thanks a lot and have a great day. Let me know how I can help. Bye-bye.